A year ago, September 2023, I was told to drop everything that I was doing because it was all bullshit and start studying ICT. A year later, I'm now well aware that that was in fact true. And I should have done that a year ago, but everything played out perfectly as it should when it should. So I'm not mad. If anything, I am blessed to be in the position that I'm in right now. I had to do everything wrong in the beginning so I could learn exactly what it is that I need to do right. I made all the mistakes in the beginning, and I'm reaching a point in my trading career, about a year and a half in, where I'm realizing that I did everything wrong in the beginning. And honestly, there's beauty in that. I've extracted so many lessons from it, and it feels amazing to finally be on the right track, to finally actually have a trade model, to finally actually have rules of engagement and a process. It's a great feeling. But I want to talk about how I actually used to torment myself trading. I used to trade supply and demand. If I go into one of these trades and just look at the screenshots, I would look at depth of market and level 2 data and heat maps. And that's what I would trade off of. And I would trade off of supply zones. And I would literally torment myself. I went into every day wanting to make money. I went into every single trading day without any model. I went into every single trading day with rules and failed to follow them every single session. It was crazy. For me, trading in this way, staring at heat maps was just not it at all. Because I'm sitting there watching every up and down tick of the market, and it just makes me chase it. Looking at every up and down tick of the market made me so impulsive. And I always broke my rules, and I always did the wrong things. I always told myself that I wasn't going to do this, and I'm going to follow my rules, and I'm going to follow my process. Never happened, never did it. Always broke my rules, never followed my trade model. I never really even had one. It was torture. And I pulled up a text message from the friend that literally told me to drop everything that I was doing because it was all bullshit and start studying ICT. And one of the text messages I said, it was in September 2023, where I texted him saying, 15 losing days in a row. 15 losing days in a row. How does that even happen? How do you even take 15 losing days in a row? I think after 2 weeks, you could probably get lucky. Let's see, it's 5, 10, 15, 16 losing days in a row. I was in such a low place that at that point, I didn't even feel anything, literally. I was just so used to losing that I didn't feel it anymore. I got the gambler's numb. When you just lost so much money, you literally don't even feel anything anymore. And then you just don't care. You just keep throwing money at the market. You don't even care that you lose money because you're just numb. You don't even feel anything. And that's exactly what I went through a year ago, last September, trading supply and demand. Crazy stuff. And now today, fast forward 1 year later, and I know exactly where the market's going to go before it gets there. And I know why it's going to go there as well. And everything, everything is going absolutely phenomenal. But look at these metrics: a 24% win rate, 70 under one profit factor, a 33% day win rate. And you know what? This metric's actually good. So good job, Lucas. Old Lucas. So I ended up losing $1,600 in the market, which isn't anything at all, really. But for me, it wasn't the fact that I was losing money. It was the fact that I was just wrong over and over and over and over again. And I still feel that today. I still absolutely hate being wrong today. I still feel that that's something that I have to cope with and battle, and I'm going to get over it because I know that if I don't, it's going to be a barrier to my success. But anyways, I literally used to watch every up and down tick of the market. Well, I still do, but I was watching every single order come in, and that made me so impulsive, and that made me break all my rules. I had no idea what the market was going to do. I came into every trading session with anxiety because I didn't have a trade model. I didn't know how to read price action. I didn't know how to read the tape. I didn't know how to do anything. Literally, I didn't know how to do anything. And I was out there just throwing money at the market every single day, which makes absolutely no sense. And sometimes I got lucky. as you can see. And other times, my inexperience really, really showed. So fast forward to today, and I've made a lot of changes. Now, this is the process that I'm going through. Now, I'm studying ICT. I'm not even taking any live trades. I'm literally just recording my observations and price action, not pushing any buttons. There's no emotions involved. A year ago, I would never, ever do this because I wanted to just get in there and start making money right away. When here, I'm not even taking any trades. I'm just watching price action, studying price action. So that shows that I have matured a lot throughout my trading journey, because this is something that I would never have done back then. I just wanted to get in there and just throw money at the market, hope I make something. I wanted to get in there and start making money right now. Now, I'm not even worried about making money, because if I know that if I do these things right, I'm going to be wildly successful. So I'm just recording observations. I'm studying price action. I'm doing weekly reviews, daily reviews. I'm learning how to control myself. That's why this is called control. I'm recording situations where I feel emotionally charged. I'm recording exactly what the market looked like in that situation. I'm journaling it. I'm reviewing all my entries on a weekly basis, called emotional study. Learned all these things about myself, journaled all of it. Conditions I don't operate well in. I'm going to create a page for every situation I don't respond well in when I feel emotions, so I know what they look like and how I can control myself in those situations. Something I never would have done a year ago. And now I have a model. So I did this today, got some new upgrades to the Notion pages. So here's my bread and butter entry model. And both of the models that I actually look for played out in today's session. So I'll review those now. So stepping into the chart today, I have a bearish bias today because the market was trading up into all of these higher time frame PD arrays. So it's rallying up into a very, very expensive premium. I don't want to see it retrace back into Friday's range. There's no need for the market to go back up here. So I'm simply looking for the market to trade up into these premium arrays, this weekly inverse fair value gap, and look for an indication that price could go the other way. So that's what I was looking for coming into today. But the very first thing that I see is my first trade model, which is where I simply just get in motion, where I get aligned with what's in motion for the London session. So you can see that in the London session, what do? We have this consolidation range. We drop down, we run these relative equal lows. So sell side liquidity is taken. We know that a stop run has taken place here because we have these wicks and price is able to overcome these wicks. So usually we can drop a fib on this and expect consequent encroachment to support price and send it higher like it does here. But if we see price overtake this wick, then we know that a real stop run has taken place. And we also know that a stop run has taken place because look at this large acceleration down into that pool of liquidity. When the algorithm is attacking liquidity, it will accelerate into it, just like it does here, because it doesn't want to give those longs a chance to remove their orders. It wants to aggressively attack it and run all that liquidity out of the marketplace, giving them no chance to pull their orders. And that's exactly what we see here, a larger down close candle into that. It's exactly what we see right here too, into these relative equal lows. My primary sell side liquidity going into 930. So it's very clear that a stop run has taken place. Not only that, what else do we see? We see a we see the new week opening gap being respected. Look at the bodies of the candles respecting the new week opening gap. Then we trade higher. We inverse the sell side imbalance that attacked all the sell stops below these lows. So because we inverse this sell side imbalance, that is a change in the state of delivery. Not only that, but we have a regular change in the state of delivery. And look what price is doing. It's respecting the upper quadrant of this buy side imbalance, sell side inefficiency. Staying in the upper quadrant, the bodies tell the narrative, the wicks do the damage. This indicates that price is strong, especially after we inverse this. Then we have a change in the state of delivery, violating the open price of this down close candle. So this becomes a bullish order block. We trade down into the bullish order block, supported, and we get sent higher again. Little volume imbalance there. We color outside the lines there. It's okay. So what is this? This makes this a propulsion block. because we have an order block formed off of the order block, or simply a down close candle trading into a down close candle. So this makes this a 15-minute propulsion block. There's your 15-minute propulsion block, and now it is very, very clear that the higher time frame order flow on a 15-minute chart is bullish, and I have a clear draw on liquidity because I have all these higher time frame premium arrays that price may want to reach up into. Not only that, but look at these very clean, smooth highs, and these very clean, smooth highs. Not only that, but I have today's new day opening gap. So if I have a new day opening gap resting above primary buy side liquidity, that is a supercharged draw on liquidity, and we can be very certain that price is going to go there. That's what I've noticed. Pair these two together, price is most likely going to go there. So we know that a stop run is done here because we overtake these wicks, run these relative equal lows. We see the bodies respect the new week opening gap, change in the state of delivery, disrespecting this sell side imbalance now becomes an inversion fair value gap. We work off the upper quadrant of this buy side imbalance, change in the state of delivery here, trade down into the bearish order block, propulsion block, and move off the propulsion block, and we accelerate into the primary buy side liquidity here, these relative equal highs, the new day opening gap, and the premium arrays above the marketplace. So we can clearly see that, I mean, look at all these strong 15-minute candles. This thing is clearly accelerating into these relative equal highs here. But I can get in sync with this move once I see all the damage done down here, and just reading the order flow right here, right? Knowing this is a propulsion block, I can use this to get in sync with the move. So I knew that this was clearly what the market was working towards because we already did the damage down here. It's not going to trade down here. It already did the damage down here. Once the sell side is taken, what's next? It's going to go run the buy side. So using that logic, drop down into the 1 minute time frame. Or maybe I should show the 5 minute first, because the 5 minute tells the same story. So when my time frames are in agreement, that's when I know I have a very probable trade idea. So this makes an entire. So if you look in the 5 minute, it tells the same story. This imbalance is also an imbalance on the 15-minute time frame, and the upper quadrant of that is also respected. So that indicates strength. This is inverted. Look how price wicks down into that. Look at that. Barely touches the upper quadrant of the inversion fair value gap, so that is indicative of strength. We got to change in the state of delivery here. Do we touch that order block? I think we do. We have another inversion fair value gap. So now we're inversing these sell side imbalances. We have a buy side imbalance respecting the upper quadrant. Change in the state of delivery here. So here's our 5 minute order block. We have another buy side imbalance. Trade into it. Wick into the upper quadrant. Repel price higher. More indication of strength. Change in the state of delivery on this down close candle. This creates a buy side imbalance. And notice how the bodies of the candles stay, for the most part, in the upper quadrant of this imbalance. What does that indicate? Strength. So I'm seeing all this price action, and it's very clear that the market is strong, and it's going to want to reach up into this pool of buy side. So that's what I was watching for at the moment, coming into 7 a.m. And I noticed that when I have something in motion from the London session that is very clear, and I have a clear draw on liquidity, and I can read the higher time frame order flow, it's clearly reaching for something. The setup to get on side with that move usually forms between 7 o'clock and 8 o'clock, and that's exactly what happens here. It forms between 7 o'clock and 8 o'clock, which there's also another opportunity to get long during the 7:50 to 8:10 macro right here on this institutional order flow entry drill, and this large range candle leaving the consolidation range. So if price is strong, this is exactly how we want to see it leaving the consolidation range. We want to see, boom, large imbalance sucking up all of the liquidity above these highs. And because we accelerate into this liquidity pool, we can expect some continuation. We're not, hanging around consolidating. We're busy. We're getting busy. We're really pushing up, driving into these highs. So it's exactly what you want to see. So notice how for the most part, we stay in the upper quadrant here. Never inverse this buy side imbalance. Maybe if this was inversed, then we could have looked for a run down maybe into here or here, but that never happened. The order flow remains bullish the entire time, and this thing trades higher. So I'm gonna delete these and go down to 1 minute. On the 1 minute. So here's where I made my first observation in price action, and here's where I got it wrong and learned a crucial lesson. So I actually want to get it wrong, because when I get it wrong, that is when I learn the most. So I want to get it wrong, and I got it wrong twice today, and I learned so much about timing the market. So I know where the market is going. That's easy. Framing a draw on liquidity is not hard for me. I know where it is reaching for. The hard part for me is timing the market, because this is what I saw here. I saw this as a bullish breaker, which it is. We have a high, a low, a high, a lower low, and a higher high. So these up close candles are a bullish breaker. And so for some reason, I had this annotated as an inversion fair value gap. And when I saw price come do this perfect redelivery of this entire imbalance right here and wick off of consequent encroachment of this discount wick, that's when I got a hypothetical long entry, because I'm not placing any trades, to then go take the market up into these relative equal highs formed. But when did the real move come? See, right here I was incorrect, and that was because this, at the time, there was a 15-minute order block right here. It traded up into the 15-minute order block, failed to traverse it, and then we see this large down range candle, large down close candle, a change in the state delivery on the 1 minute, trade up into that order block, respect it, another change in the state delivery, respect the order block again, and then what are we aiming for? We're aiming for the relative equal lows. So I got long here thinking we'd trade up into here, but what price really wanted to reach for before it did all of this was these sell stops down here. So the run on the sell stops down here was what the algorithm needed to start a buy program and aggressively start repricing towards that pool of sell side liquidity right here. That's all it needed. So timing the market, when I am timing reversals, I really need to see price engage some liquidity. Which right here, we don't really see it engage any liquidity. We see it respect this imbalance, but that's about it. It doesn't really do anything else other than that. And then we can see here the narrative never changes, because the bodies of the candles still close inside of the buy side imbalance. We run these relative equal lows, and then boom, look at these large, aggressive, up close candles. And look how the market is so strong that it does not even reprice down to these imbalances down here, which is exactly what you want to see. You want to see these left open if the market is really strong. So we inverse this sell side imbalance and this one. We have a change in the state of delivery, close over that, trade down into the order block, respect it, accumulate longs inside of the bullish breaker. Here we have a buy side imbalance, trade into the upper quadrant there, wick out of it, boom. And then we accelerate into the relative equal highs. So framing a narrative is actually really easy. You just look, where's the market smooth, and whatever side of the marketplace it takes first, the other side is what you're aiming for. That's pretty much it. And that's how this whole trade right here can be framed, and it works, literally. It was smooth here, and it was smooth here. Which one does it take first? Down here. Okay, the next side of the marketplace is it. So you can get long inside of the bullish breaker. Look how it accumulates inside the bullish breaker institutional order flow entry drill before we accelerate into that pool of buy side. Right here, these relative equal highs. So this is exactly how you want the market to approach a pool of liquidity. If it is going to continue, you want to see speed and magnitude into it. Then we leave this large imbalance right here. I'm not sure if this would be included. Maybe it would. I don't know how to include indecisive candles into imbalances. But we have an institutional order flow entry drill during the macro. So if I didn't get long down here, here's another chance to get long. Speculating that we will drive up into the new day opening gap, the buy side above here, and the premium arrays. So that's that long scenario. I simply had it wrong. I just slightly mistimed the market, which is okay, because now that I know I need to see some measure of stop runs. So every time that I get it wrong, it's perfect. I go back through and I just extract my lesson and I get better. I don't care to get wrong, which in the past, when I was wrong, I would just freak out and I would just lose my shit. All bad. So there's this example right here. I'm gonna delete this. Okay. Now, this little consolidation phase right here gave me my perfect little box of price action to look for the market to reach down into in this market maker sell model. So I was anticipating all this right here. I think this is the market just getting really excited. It's pumping into a very, very expensive premium, and I'm not willing to buy at these higher prices. I want to sell an expensive premium and buy a cheap discount. If I know I can get the market cheaper later, then I will wait until then to buy it. But right now, it is extremely expensive. It is trading to a very high premium. So I'm not looking to be long in this thing. I'm looking to be short. And look how the 15-minute candles close below all these premium arrays. So this right here, from here to here, is the balanced price range on the daily time frame. Here's consequent encroachment of that. So we close below consequent encroachment of the balanced price range. And then from here to here is a sell side imbalance on the daily chart, which I should probably show. So Thursday's range and yesterday's range and Friday's range formed this sell side imbalance on the daily chart. So I have a new PD array. I have to incorporate that into my analysis. And if we look left, here we have a one side pass, and here we have a one side pass. So this becomes a balanced price range. So I would want to see this act like a wall to price and keep price below it. You can see that later in the day. Obviously, we close over all this. So I'm not even sure what to expect tomorrow. This is my first time that I'm observing price action during CPI or PPI, so I'm not sure. But I was expecting this to act like a water price and hold it down because it's a balanced price range. That's how we want balanced price ranges to behave. You want it to say, nah, you're not going any higher. So that's what I was expecting there. And I see all the closes below these premium arrays, and that indicates to me weakness, even though I have all these right here. So this little original consolidation, I'm aiming down here. This gives me my primary sell side liquidity. So I'm looking for something to sell up here, and I'm going to target down here. And it does deliver, it does do that, but it just takes forever. Price action today was trash. It was terrible. It just hung around, chopped up, down, left, right, and then finally eventually rolled over. So the draw on liquidity was correct, but again, I mistimed the market post 9:30. I got my entry, my hypothetical short entry, a little too early. So I was extremely confident that the market was not going to reach the high of this balanced price range because I wanted to see it hold down price. I wanted to see it act like a water price. I don't even want to see it touch the high of this range. What did I just do? So I was extremely confident in selling short above this little high right here. And how far can the market reach into the balanced price range? Well, you have to look what PD arrays are incorporated inside of that balanced price range. We have an inversion fair value gap right here. Now, at the time, I wasn't aware of this, but this is something that I do know. I just didn't use it in this moment. I looked after the fact and I was like, oh, that's why I traded all the way up into the balanced price range, because it was referring to this inversion fair value gap. So anytime you have a gap, this isn't a gap, it's a balanced price range, but it's also part of a SIBI, you want to think how far can it trade up into that inefficiency. And all you have to do is look left and see what PD arrays are nested within this inefficiency, because ICT states in the 2024 mentorship that if there are other PD arrays inside the inefficiency, it changes the characteristic of it. It classifies it as something else, different, and it will behave differently. So in this case, we have an inversion fair value gap nested inside of the daily buy-side imbalance, or not buy-side imbalance, sell-side imbalance. So it can trade up into that, and it does, and that's where we form the high. What the heck? For the morning session. So initially we pump up into a premium. I think this is all just getting really, really excited. I'm not looking to buy this thing. Large down close candles. We have first presentation here. First presentation is inverse. We trade up into it, reject it. So I'm thinking this thing is heavy. And I'm thinking down here at least, because I know that 70% of the time in the first 30 minutes market open in the opening range, we trade to consequent encouragement of the opening range gap. So today we had a premium gap opening, and I'm thinking we could easily trade into consequent encouragement of the opening range gap. So initially we trade higher, we run buy side, so what's next? Sell side. Once we close over this series of up close candles, I have a change in the state of delivery. I also have a bearish breaker, which is this series of down close candles. So now I'm looking to sell short on any return up into the order block and as well as the bullish breaker. Here's also an inversion fair value gap will reach up into that. So here's my hypothetical short entry, which was at 9:37 a.m. And I was thinking down here the entire time. The problem with this is that we run into consequent correction at the opening range gap, and look how the bodies just stop right there. Respect it. We hang around in this sell side liquidity pool and we accumulate, and then we retrace against me and hypothetically stop me out. So running a pool of liquidity, this is not how I want to see the market react to it. I want to see it do this, right? I want to see acceleration up to and through it. But this is not what happens here. We have large down close candles approaching it, but once we run it, it just trades sideways, accumulates, it hangs around, and it spends time in that pool of liquidity. What you don't want to see is the market spend time in that pool of liquidity. You want to see it run through it aggressively, like we do down here, right? So here's was my objective, and look how we trade through it. Boom, large down close candles. Now compare that to this. We touch it, but yeah, then we just start to hang around. It's very wicky. It's back and forth. It's pretty disgusting. So it just spends time here. It accumulates and then reverses against me. So I view this initial drop lower as the sucker play. I view this as just an initial drop to get retail shorts suckered into the market, engineering more buy side liquidity, which for me today, I was the liquidity because I got suckered into the market short very early. And then they make a run against all those sell stops, or not sell stops, buy stops, and then the real move of the day occurs. So here is another lesson on timing the market. Now this is very early into the market open. This is at 9:37 a.m. And the real move comes during what? The macro. Wow. What a surprise, right? So if I just wait, if I just be patient, initially I was thinking that maybe I should just get my hypothetical entry on the first presented fair value gap. We could probably draw up into that, use it as an inversion fair value gap, and then roll lower, which is exactly what happens. But I wanted to get in this thing short, fast, and early into the open because I just saw these large down close candles and I started, freaking out, panicking, got a little bit of FOMO. So hypothetically, I got short here. Way too early into market open. The real move comes in the first presented fair value gap. And it also has an SMT. So if I look at ES at the same time, we can see that ES makes a lower low. Why does it do that every time? As NQ makes a higher high. So there are multiple things that I can use to time the market. I can wait for a run on liquidity, which in this case we do right here, right? But this is also a run on liquidity as well. Not so significant though, because it's just this little minor pool. But we run out the buy stops above here. We have an SMT and it's during the macro. So this was the prime time element that the market needed. Everything came together during this period of time. That's when the real move happened. So just a lot of lessons on timing the market today. I knew where it was going the entire time, which is good, but I need to work on timing it. But I'd much rather trade this way than how I used to trade when I would trade supply and demand. So I think it's just absolutely crazy how far I've come and how everything is just falling into place exactly as it should, when it should. It's perfect. And I trust that everything will go as it should. And eventually, I will achieve the life that I've been working towards for the past year and a half. I will get my independence. I will be able to support myself. I will be able to move out of my house. Don't need to rely on my parents anymore. I can support my girlfriend. I can buy my own house. I can buy my own car. Everything will be great. All that is coming probably within the next year. I could see it definitely coming within the next year. But anyways, that's it. See ya.